Hello, everybody, and welcome to the Dorsey Wright Podcast. I'm Ian Saunders.
And I'm Eric McCardle.
And it is Wednesday, November 20th. First podcast that we had after having the Broker Institute here last week. So for those of you who came, thank you very much for coming. For those who didn't, we had our second of two point and figure institutes that we have each year. This one was held here in Richmond, Virginia, and it took place last Wednesday, Thursday, and Friday. So a great event. Got a chance to meet with a lot of y'all, a lot of advisors there that are using the platform, hear some great ideas. Hopefully we gave some good ideas to you as well. But all in all, great event, and thank you very much to everyone that was coming. Now, jumping back into the market movement that we've been seeing here over the past week, things are really steadily kind of continuing higher and getting pretty high. At least if you're looking at the chart, the default chart there of the S&P 500, we're looking at a pretty big column of X's up there, one of the bigger ones that we've seen this year, moving the market into a general overbought status. And you can see that as well. The chart of the default chart of the S&P is at 74% overbought, so it just kind of crossed over that 70% threshold that we would typically consider to be an overextended territory. But as the market's making new highs, not necessarily a major concern, but definitely something to be aware of. And we've seen that on some of the other indicators as well. If you look at the weekly distribution for the S&P 500, that's in the technical indicator report, just looking at the percentage of securities that are going to be in overbought territory in that S&P 500 universe, it's also been creeping steadily higher. However, it's not quite as high as it was earlier this year. So even though the general state of the market is moving towards that overbought territory, not every name in there is going to be overbought currently. So an interesting dynamic that we're seeing play out there. Is that right, Eric?
That is right. And, kind of moving and echoing on your sentiment, we're seeing, especially large caps, more toward that heavily overbought side of the distribution curve, which makes sense given that they've really led the rally for the broader domestic equity space in 2019, and of course more recently, as that OBOS indicator would suggest, right? We're looking at a 10-week trading band for the position. And one way to dive a little bit deeper than, say, the S&P 500 or the NASDAQ 100 would be to go into asset allocation and asset class group scores. And what we can do here is we can check U.S. styles in the filter section, hit set view, and then from here, we can assess the OBOS readings for domestic equity, size, and style categories. And, that observation that we get here is right in line with what I mentioned earlier, where the large cap names are heavily overbought, mid and small caps on the overbought side of the distribution curve, however, not as elevated, right? So, as you mentioned, everything leaning toward the right side. That said, a little bit of a different picture across the overall equity space. Yeah. So, what do you do in this environment, right? We know that there's strength across the board. We've touched on this in the past few weeks, that small and mid-cap names are improving, large cap names are remaining strong. So if you have money to put to work, how are you going to go about this in an efficient manner without overextending? And I think one of the ways that you can do this is by using our database reports, which are found under the Security Selection and Security Screener tool. And within the database reports, we have what's called a buy on pullback query. So this is going to look for individual stocks or ETFs, if you change the filter, that are technically sound, trading above their bullish support line, but have pulled back to a more actionable level. And when we run that report today, we see a couple of names that stand out, right? Some big tech names that we've been following throughout the year and the past couple of years. The first of which, Alibaba, strong 5-for-5er, recently pulled back from a multi-month high at 188, remains on a third consecutive buy signal, so offering a more attractive entry point for long exposure to that Chinese e-commerce name. Another name that does show up on that report is Facebook, right? So tech in the domestic market, we look at Facebook, another 5-for-5er, 3 consecutive buy signals, has recently moved past resistance at 198 to 200. And so overall, both of these are actionable from an OBOS standpoint and technically sound. So a good report or a good query to go check out on the platform. And again, you can toggle in the top left to see ETFs or funds if you want to look in that space as well.
Absolutely, and I mean, we're seeing a fair amount of names pull back across the broader market here over the past couple of days. I mean, some are moving to overbought territory. You're seeing a few that are pulling back there, such as the Facebook or Baba. Another one that we saw that was pulling back here today due to the earnings release was Home Depot. Right, we're looking at the chart of that. You're looking. I mean, talk about consistency this year. We were looking at 5 consecutive buy signals throughout this year. The highs up around 236, but they missed their earnings report this morning, and so we're seeing a little bit of a pullback there back down into a column of those levels of 224, moving into slightly oversold territory. Actually, it was a little bit oversold yesterday at around 30% oversold. Likely will be a little bit lower here today, down just over 1.5%. However, looking at the longer term picture of the chart, it's Home Depot still a 5 for 5er. It's not quite in the top half of that building sector matrix, but the building sector is one of the favorite sectors that we have on the platform, so generally favorable area. And you're looking at a consistent stock, been in a positive trend since March of 2009, been on an RS buy signal against the market since the beginning of 2012, and it carries that 2.45% yield there. So just because you might see a name in the headlines, Home Depot missed earnings, taking a look at some of the objective technical picture there says, well, by and large, we're just seeing a little bit pull back down into a column of those, nothing to be overly concerned with at current levels, right?
Yep.
Another name on the flip side of that, though, would be looking at Kohl's, right? I mean, that was a stock that has experienced a lot of weakness over the past, from a year-to-date basis, really since May. Showed some near-term strength, gave 2 consecutive buy signals there, rose from levels of around 44 up to bump right up against that bearish resistance line at 59. However, yesterday, reversed down, big column of those down, moving back to a sell signal at 50, continuing lower today. Kind of a tale of two stocks, if you will.
Yep.
Looking very, very different technical picture there. A longer term perspective of Kohl's. Yes, it does have that high yield there in a similar fashion to Home Depot. However, much lower in its sector matrix, the retailing sector, which is an unfavored sector, and it's only a 2 for 5er from an attribute perspective. So an important thing to keep in mind when you're looking at these securities that, okay, maybe a slight earnings miss, moving lower, definitely an important thing to take a look at that broader technical picture to look at the longer term trend.
Yeah, exactly. And 2 points on that, Ian. You mentioned the yield, and a lot of investors are hungry for yield now, and they have been really over the past decade or so. But I think when you see a weak attribute name such as Kohl's, and you've got that elevated yield, there's a reason for that, right? So be careful not to get tempted into chasing weak attribute stocks with high dividend yields. And the second point is, we often refer to the bullish support line, or in this case, the bearish resistance line, as somewhat of a brick wall, right? And so it's really interesting when you have an example such as Kohl's, where, as you mentioned, you can see the stock rallying up near a test of that bearish resistance line and then subsequently reversing down. So, you can find a lot of examples like that on the platform, or just when you're charting using point and figure in general. But kind of interesting, right? It's just something that we talk about a lot, and I think it's neat to see that example come to fruition.
Absolutely. And when you're looking for to weed out names like Kohl's maybe from your portfolio, right? This general kind of overbought state of the market leads itself. We're looking at the buy on pullback report under the database reports section earlier. We also have another report called the sell on rally report, which is looking at some of these lower names, these names that have experienced a fair amount of weakness, but maybe broader market movement or maybe just the individual movement has led to a near-term rally towards the normally distribution levels there on the chart. Could give you the opportunity to sell out of one of these weaker names at a potentially higher price, right? So that's another great report. If you're looking to identify times to move out of some of these laggards that have been in your portfolio as the markets are making new highs, using that sell on rally report to say, okay, well, this name's moved back up, might be a good time to get out at a little bit better price than you would have maybe a week or so ago.
That's right. And as we're moving to new highs, volatility in the market is pretty low relative to what we've seen over the past couple of years. In fact, near the lowest levels of the year. And so we know that will not always remain the case, right? So the reason we bring up these actionable ideas in these reports is because we know that, tensions are somewhat high with all-time highs, right? It always, kind of puts people on edge a bit. So rather than being on edge, have a game plan and be able to act on it. And I think that these are great tools for doing that.
Absolutely.
And kind of ending here, Ian, we've talked about some of the different opportunities in the market. We wanted to revisit two stocks that have gotten a lot of attention this year, and for good reason, right? They're names that have performed extremely well and are kind of on the edge of what's called the fintech space, right? So looking at companies that have financial exposure, but also could be considered technology in a sense. And the first of which is going to be Visa. All right, so this is a strong 5 for 5er. It's trading well above its bullish support line that was established in 2011. And Visa had returned to a sell signal back in September and kind of put investors on edge. As it does, right? You see a strong stock that's rallying, and then you see it pull back a little bit. You wonder, okay, is this the end of that rally? Well, we've recently seen Visa return back to a buy signal and looks pretty actionable here, right? So again, strong 5 for 5er, very solid from a technical perspective, and we're okay with adding long exposure here with initial support at 176. So I would like to see it move past resistance at 182, but overall, looks very, very compelling.
Yeah, and another one that we have, a general adage that we hear tossed around, at least our office here a lot, right, is when you have a security that's given multiple consecutive buy signals like Visa has, strong uptrend, that first sell signal is oftentimes going to be a false signal, right? You've had a lot of consistent growth. Maybe that first sell signal is just a time for people that are a little iffy about the security. Okay, they've moved out. Now the security can continue higher. In a similar fashion to a shakeout pattern, just without the actual shakeout pattern, right? But another name that has been really exemplified that has been MasterCard in the same space, in the fintech space. You want to talk about big growth this year. We're looking at 5 consecutive buy signals, moving off of lows at the beginning of this year at 182, reaching a new high up at 292 in September of this year. And then also moved to a sell signal there in October. We saw it reverse lower, give a sell signal at 260. However, recent movement over the past few weeks, the general kind of upwards movement of the market, and especially of the financials group, has led to a new buy signal there for MasterCard at 284. Again, strong looking name from a longer term technical perspective. 5 for 5er, positive weekly momentum, top half of that finance sector matrix, which has seen some consistent improvement. And we've seen that improvement through some broader ETFs that look at the financial services group as a whole, such as the iShares U.S. Financial Service ETF, IYG, of which Visa and MasterCard are both going to be pretty heavily weighted within that fund at over 7% each in that particular fund. Very consistent, 3 consecutive buy signals this year, strong fund score. A little bit overbought, so maybe taking a look at some of the individual securities that are not quite as overbought in the current state could be a good option for you, or maybe utilizing that ETF if you want that broad exposure with some potential price normalization there could be a play as we head towards the close of the year. So.
That's right, and just one follow-up comment on your point regarding financials. When we pivot back over to asset class group scores, we see that the financials banks and the broader financials group are some of the most improved of all the sectors, right? Both are over that acceptable 3.0 fund score threshold from a group perspective, and really showing some near and intermediate term strength. So don't count them out. Certainly take a look at those from a broader allocation perspective, and names like Visa and MasterCard are a great place to start.
Absolutely. And if you want to deeper dive into any of that kind of financial group movement specifically, I believe we had that in the fund score overview article towards the end of last week. So definitely a point to come back and rehash if that's something that you're especially interested in. Or, as always, you're more than welcome to give us a call here, and we're more than happy to help you out on any of this movement we've discussed today, or really any movement that you're seeing, any kind of client questions that you're getting, stuff that we love to hear, right? A lot of the great research pieces, the great research ideas that come out of the office here start from you, start from the clients, start with the questions that you're getting, and you come to us, and hopefully we can help provide some answers there. So.
Well said. Well, great. Well, with that, always a pleasure, Ian. For you all, talk to you next week.